Hi everyone, welcome back to Corporate Decoder. Today we are diving into Donaldson Company's Form 8K filing. It's about as exciting as watching paint dry, but trust me, there's some financial magic hidden in this document that can mean big changes for the company and maybe even your investments. Donaldson just made some moves with their credit agreement basically. They borrowed a bunch of money and extended their payment deadlines. Let's break it down, and before we start, if you want this kind of content in real time, come join us on our Discord server linked in the description below. Okay, so on June 12, 2025, Donaldson changed their credit agreement. That's the deal, they have to borrow money. They made something called a second amendment. Basically, they tweaked the rules of their existing loan to get more money and more time to pay it back. Here's where things get interesting. First, the deadline to pay back the money was extended from May 2026 to June 2030, so now they have more time. Second, Donaldson increased their borrowing limit. They can now borrow up to $600 million. That is up from $500 million. They can now borrow up to $600 million. That is up from $500 million. Think of it like raising your credit card limit. Third, a new loan for $200 million was added, and it's due in June 2028, so they got even more cash. Then part of the old debt was paid off using this newly borrowed money. Finally, they can ask for even more money in the future if they need it. The option to increase the credit even more went up to $350 million. One for $200 million was added, and it's due in June 2028, so they got even more cash. Then part of the old debt was paid off using this newly borrowed money. Finally, they can ask for even more money in the future if they need it. The option to increase the credit even more went up to $350 million, and to increase the credit even more went up to $350 million. After all of this, Donaldson still owed $60 million. Now, let's talk interest rates because that's how the bank makes money. Donaldson can choose different rates for the $200 million term loan facility, which is finance speak for the loan they are going to use to finance something like new machinery. If they pick a term SOFR loan, it's calculated by adding together two things. Adjusted term SOFR, which is a benchmark interest rate, which is subject to 0% floor, basically meaning Donaldson won't go below zero, plus what they call the applicable rate, which depends on how much debt Donaldson has compared to its earnings. Alternatively, they can go with a base rate loan. Here, the interest is the higher of three things. The rate the bank charges its best customers, 0.50% plus the federal funds rate, or adjusted term SOFR for 1 month plus 1.00% floor, just like before draw, and again, they will add the applicable rate based on their debt. Wells Fargo and US Bank helped Donaldson with the deal, and they have done other things for the company in the past, like normal banking and currency exchange. Donaldson pays them for these services like others would do. The fact that Donaldson entered into the Second Amendment means they are in deeper with having to pay interest and the original amount they borrowed. The credit line available is now $600 million. Also, there is $25 million set aside for letters of credit and a $200 million term loan. If you want all the nitty-gritty details, the full Second Amendment is attached to this report as an exhibit. It goes into even more detail. So what does this all mean? Donaldson is taking on more debt, but with longer to pay it back, and the option to borrow even more, it could mean a few things. First, Donaldson probably sees opportunities for growth. Companies usually borrow money when they want to expand. Maybe they are planning to buy another company, invest in new technology, or build new factories. Usually this is a sign the company is confident and wants to grow, but it can be risky, especially if the company has trouble paying back the money. Second, Donaldson believes it can manage the debt. The company is betting they can earn enough money to cover the cost of borrowing, with the interest, and eventually pay back the loans. This isn't always guaranteed. Third, Donaldson might be preparing for a rainy day. Sometimes companies borrow money not to spend it right away, but to have a cash cushion in case of an emergency, like an economic downturn or unexpected expenses. Is this a good move? It is hard to say for sure without knowing exactly what Donaldson plans to do with the money. On one hand, it could fuel growth and increase profits. On the other hand, it could lead to financial problems if the company overextends itself. Now, if you feel overwhelmed by all this and still don't understand, that's fine, since the next time you watch this video, you'll understand it better. Donaldson seems to be positioning themselves for growth, but now they have higher stakes than before. Tigin, what do you think should Donaldson do with all that cash? Alright, that's our breakdown of Donaldson's latest filling. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.